Right. In this section, we're going to start talking about costs. And as I said in the intro, as I wrote in the intro, the costs are very important if we're going to understand different structures, different types of industry structures. Okay. So this first video is just going to go through some basic ideas, and not really get too far into the details. So we know that our profit is equal to our total revenue minus our total cost. Okay, and that's kind of an intuitive thing. So profit, again, this here is total revenue, so all the revenue of the firm, and then this is all the costs of the firm, and what's left over is our profit. Okay, so that should be pretty intuitive, and we already know about revenue. So total revenue is just, assuming the law of one price, it's just P times Q. Okay, so that's our total revenue. Now what we're going to do now is we're going to talk a little bit about total cost. Okay, so total cost includes the value of all inputs used in production. Okay? So the value of all inputs used in production, and it includes, for economics, it includes opportunity cost. Okay, so we're going to so in this video, we're just going to walk through this idea briefly, and then we'll get into some of the more technical parts in a little bit in a future video. Okay, so economics includes two kinds of costs. You can kind of put it there. In the text, I've listed the different categories, but I'm just going to give some examples here. So it includes different things. So it includes, one is explicit costs. Explicit cost is a cost that you can see, right? So this one will actually involve money leaving your pocket. Okay, so this could be rent, it could be wages, it could be natural resources, okay, etc. There's other things that it could be as well. Explicit costs, and we also have implicit costs. Okay, so implicit means it's like hidden. And so we're going to have several kinds of implicit costs. So these are hidden because we don't actually spend money. So we can say they're hidden because they don't actually involve money leaving your pocket, but they do involve you having less money than you would have otherwise. Don't actually, because you don't pay directly. Okay, so what are these? Well, these are usually a couple of things. So I think it's maybe giving an example is a good way to do this. So implicit costs include things like opportunity cost of your time, So for example, if you're an entrepreneur and you start a business and you give up your job, then that's an example of an implicit cost. You could have been earning a wage in your job, but you had to give it up in order to start this business. Okay, so you have an opportunity of time, financial capital, and your own resources you use. Okay, so if let's suppose you had a bunch of money that you invest into your business, then that has an opportunity cost. So you didn't have to borrow from a bank because you instead used 50,000 of your own money. Well, you can't say that own money was free because actually you're giving up the chance to earn interest or dividends on that money, for example. And also, let's suppose you had your own building, and before you were renting it out, but now you're going to start a restaurant, so you're going to use your own building for the restaurant. Again, this has an opportunity cost of using it, so economists will definitely consider that. So that's just some examples. Okay, just to give an example here, you quit your 100,000 a year job to start a business. Okay, so again, that 100,000 a year is going to be considered opportunity cost here, right? So we're going to count that when we're counting our costs. We're going to consider that as one of your costs. Now, accounting wouldn't necessarily consider that because it's not something you have to pay, but it is something you're giving up. So it is the relevant comparison for at least for the way economists think about this thing. Let's say you use your building, you use your own building for the business, and you give up. I don't know, let's say $3,000 a month per month. So these are both examples of implicit costs. So it's usually alternative uses of your time, your financial capital, or your physical capital. So again, we would then count that that you gave up the chance to get that rent, we would then count it as a cost. Okay, so now let's compare. The last thing I want to do in this video is just compare something we generally call economic profit and another thing we'll call accounting profit. Okay, so this symbol means profit, so that's profit. So this is economic profit. It actually is total revenue minus the two kinds of costs, explicit costs and implicit costs. So we consider both kinds of costs. Whereas the kind of a profit that your accountant would tell you, so accounting profit, so again this symbol means profit, is typically just calculated as your total revenue minus your explicit costs. Okay. Firms have started to pay attention to this and add in methods to value when they use their own capital, but generally they're still not counting things like the opportunity cost of time. Okay, so because of this, it's possible, and I'll give a story about this, it's possible to have your accounting profit is greater than 0, but econ profit is negative. Okay, so how would that happen? How that would happen is, let's suppose yes, once you do your revenue and you pay your workers and you pay for your resources and everything else, then you have money left over. So for accounting wise, you have profit. But let's suppose your alternative was to work in your job making $100,000 a year, and out of this business, your accounting profit is only like $50,000 a year. Okay, so an accountant would say that you made $50,000 doing this business. An economist would say that you lost $50,000 doing this business because your alternative, you could make 100 and you only made 50 here, so you're doing 50 worse than your best alternative, right? 50,000 worse than your best alternative. So that's the idea we're talking about here. Okay, so let's summarize something and then we will take a break. So in the long run, if your econ profit is greater than or equal to 0, the firm will stay in the business. So that means you're doing as well as you can anywhere else or better, right? So as long econ profit equal to 0 is not bad at all, because it means you're doing as well as you could anywhere else. So if you take all the money you have invested in this firm and you put it into something else, you would get the same. That's what econ profit equal to 0. If you quit your position running the company and instead went and found a job with somebody else, your return would be the same. Okay, so that's what that means, and that's what 0 means. And greater than 0 is great. It means you're doing better than you could do anywhere else, right? In the long run, if our econ profit is less than 0, expect the firm to exit. So eventually they will quit the business. Okay, so what does that look like? Well, it might be that you pay all your workers and you pay all your expenses, but the one thing you can't do is you pay all your workers and all your expenses, but you're not able to cover your own opportunity cost of your own time, or maybe you're not able to cover the true opportunity cost of the financial capital that you've invested in your business, and you'd be better to liquidate it and then put that into real estate or into the stock market or into something else. So anyways, I hope that's clear. Let's just give a brief introduction of the economic idea of costs and profit, and in the next one we'll come and look specifically at the details of the cost function.